So welcome to today's webinar, Impact Investing in Emerging Markets, Opportunities for Institutional Investors. My name is Laurie Spengler. I'm a board member of the UK Impact Investing Institute, and in that capacity, I lead our international development work. Our conversation today is informed by really what's happening around us, the build up to COP26 and the increasing focus on mobilizing more capital to address the climate emergency, the recognition of the long tail of COVID and the long tail of COVID recovery, particularly in emerging markets, and really the setback in achieving the SDGs that many of our markets are experiencing. At the same time, we're seeing a surge in ESG investing, and of course, our continued growth in impact investing. In today's conversation, we did really want to shine a spotlight on institutional investors and emerging market investment, not because they're the single group of actors we want to focus on, but we all recognize we need to mobilize more and bigger pools of capital to participate in and invest in emerging markets if we want to build the inclusive, sustainable future we envisage. And so that's why we really wanted to spotlight institutional investors. The timing of this webinar is also informed by the release of a series of case studies by the Institute that you can find on our website. My colleague, David Krivanek, will talk about those case studies in the course of our conversation today. They really highlight the depth and breadth of opportunity in emerging markets for institutional investors. As we have our conversation today, we are absolutely delighted to be joined by Matt Christensen, a familiar figure to many of you in the field. Matt joins us as Global Head of Sustainable and Impact Investing at Allianz Global Investors. Previously, he was with AXA Investment Management, where he spearheaded the impact investing initiatives there as Global Head of Impact and Responsible Investment. Matt is certainly a leader in the field. More importantly for this conversation, he has hands-on experience steering and leading an institutional investor in deploying capital in pursuit of impact. On a personal note, I have had the pleasure of knowing Matt for many years, actually more than a decade, I realize, Matt. And we've been around some of the same tables together, debating transactions, discussing field building initiatives and more. And I've always found Matt to be incredibly thoughtful and engaging, willing to dig into the real issues. He's been incredibly open, pragmatic, results-oriented, and determined in building his career in impact investing. And all of those qualities, I'm sure, will shine through in our conversation today. Just a word about our format. Matt and I will kick off in conversation together. We'll then take a bit of a pause and invite David to highlight the case studies that I referenced. And then Matt and I will continue in conversation and we'll open it up to the questions from all of you. I would encourage you to be posting your questions in the Q&A button. So I would ask you to keep introducing yourselves in the chat window, but please use the Q&A to post your questions, and David will help us go through those questions and pose them to Matt later on in our conversation. And just a reminder that today's session is being recorded. It will be available on the Impact Investing Institute's website in the coming days. So with that, Matt, thank you so much for joining us. We really appreciate your time and your engagement. So thank you.
Thank you for that extremely generous introduction, Laurie. It's great to be here for the conversation.
Thanks so much. And Matt, I think I'd love to kick off on the personal. I think when we look at people who really built a career and been in the field for as long as you have, I think it's interesting to understand the pathways that leaders take in their personal journeys. So if you don't mind, if you could share a little bit about how you arrived at a career in impact, just your personal and professional journey, maybe a couple of the milestones along the way.
Well, I'd like to think it will be a bit more straightforward for those that might be in, let's say, graduates of various undergraduate institutions or graduate schools than it was for me at the time, or even probably for you, Laurie. I suppose the kind of milestones that I would just do briefly were that I started as what I would call a mainstream type of profession, which was strategy consulting. So call that the way to, when you don't know exactly what you want to do, a way to see business. That was certainly one of the reasons I went into that profession. And I always thought that extremely interesting, dynamic, get to learn a lot, given a lot of responsibility at a fairly young age. And but also a little bit of a gnawing in the back of the head of, aren't there things that are missing from the picture? And that was a little bit of the drive for doing business school. I did a dual degree program, an MBA and a Master's of Arts in International Political Economy. And part of that was this idea of searching for, how do I combine the interest in society? That's how I would use the language now. I don't know if I had that language then, while being a participant in business. I did work in politics for a bit, so I tried that avenue as well. And I'd say that the breakthrough was when I went more into the startup world. I was a business development person for the Motley Fool, really opening up their European divisions. And it was probably there that I learned about the idea that if you look at investing, this idea of goodwill and intangibles as a value, you could start to see that when you think about investments, and that was what the Motley Fool's business was teaching people about how to invest, and also teaching people that it's not just about the book value, it's about how do you think about intangible value. And that's where sustainability started to be a discussion point of, what is this sustainability stuff? How do you measure it? Stuff we still talk about today. Right now, it's how do you measure impact, right? At that point in time, it was how do you measure this intangible area that, from my business school education, one of the things that I remember quite passionately was I felt like I was one of the people arguing that it's not all priced in the valuation. And I was there very much under the Friedman doctrine at that time of my education. I think there's now other challenges to that way of thinking of the shareholder value argument, but it was always about, it's priced to the market. And if you don't see it and you don't measure it, it doesn't matter. That was a little bit of the sort of, I say what was in the water anyway. So in terms of the search, Lori, it was always about, I feel there's something missing in the career and in the way that we look at things, and how do we find that? And that's a really, from the Motley Fool, it was a jump then towards moving into sustainability. And when I really got in there full time was back in 2002. And that was as a founding executive director of the European Sustainable Investment Forum. So I went from a for-profit career path to jump into a business nonprofit startup. And then from there, moved into asset management full time, which was at AXA and now at Allianz GI. So those were all sort of peripatetic ways to have gotten there. So sorry for the lengthy answer, but there was no traditional linear way to go into this.
That's fantastic. And thank you for taking a few minutes to share that with us. I think the combination of experiences really interesting, and how you wove those experiences together to your current pursuits. I think your comment also, Matt, is true, certainly compared to when we were navigating our way through. I think there are some more straightforward pathways now that frankly just didn't exist. But yet I still think that combination of perspective that you highlighted, I just, from my personal view, I think that's really valuable in doing what we try to do around impact tables. That's terrific. So may I ask also, were there any moments where you really had a doubt about this impact resonance, the intangible values of linking to society? I mean, were there moments where you just thought, wait a minute, I'm not so sure this is really going to be the way I propel my contributions?
What's interesting is there were many. And if you think about the big picture on doubts, the doubts have gone from what I would call career risk, right? That was the major doubt, to more about how do we, in this onslaught of interest now, how do we ensure integrity? So very different sort of doubts about where we stand. I suppose I'll share one anecdote about the doubt. There were so many, but somewhere around 2005, I'd been 3 years at the European Sustainable Investment Forum, and listening to quite a few of the naysayers from my business school background or others I'd met in the more mainstream industry saying, when are you going to come back and take a real job? Those are the kind of questions I'd be asked. And I remember facing that with a very concrete example, which is funny to look back. I was offered, as part of the background I had, a pathway back into what I would call the mainstream, which is business development as a skill set had become one of the ones that I had over the years. And it was a competitor to what became Facebook. It was MySpace, what I consider to be one of the originals in terms of social media. And they offered me a job to be a business development head in Europe. And I looked at that point thinking more traditional. You could see very much where that could go, even if MySpace blew up, or stay in what I was developing. which was sustainable investment, high conviction, but very much a having to prove that there is a ability to do this and make money. That was most of the conversations I was having back in 2005. And I decided to stay. And then you look at MySpace blew up about a few years later. Facebook took over that market. Facebook went from being a poster child of called the good side of social media with Arab Spring to more of the questionable in terms of US elections. So it's an interesting pathway they've had. But that would be one example of doubt. There were many that came into the picture about how do I show that in my career I can sustain it, and that in terms of the impact, that we can show that there's a real world impact in thinking about sustainability as a pathway for investors to not just make money, but to show that they're doing something that's different than traditional investing, of which I think, we could talk a bit more about that today, because I think that's the current discussion now.
No, I think that's fantastic, and I really like the evolution of your frame from risk to now navigating the and protecting and preserving the integrity, but also your career trajectory shows the longevity, and this is the long game. We are playing the long game here. I know the sense of urgency is absolutely real for all of us and for the institutions that we're part of, but that sustained longevity of commitment, I think, really comes through. The last personal question I wanted to ask you, Matt, is if you can cite, I'm sure there are many, but one of the most satisfying elements of your journey, if you could just share with us, and then we'll move into the market assessment.
Certainly, in any time you get a real world story when you're involved in impact investing, those are the fantastic reminders of why we do this. So real world stories that come to my mind, they can be that you have seen that the financing that you helped to get done through an impact investment might have improved the livelihoods. I'm thinking of some investments we did now in the emerging markets with really healthcare, where we really saw the impact that made, and both in terms of physical buildings that were developed around hospitals and clinics, but also in terms of family livelihoods that were improved upon in terms of health improvements, and that you could actually see that happen. So those are the kind of real world moments that bring your job back here that could be abstract in terms of what you're doing between harnessing and trying to get a mobility of capital, right? It's a big part of our jobs, but then to see what actually happened with it. That's one classic example. I'll give you two others that you might find interesting, Lori. A different one would be that in starting the impact investment program at AXA, where I was prior to where I am today, seeing the change in let's say, the people that became involved in the program. I'm thinking some of the ones who are still there now leading the charge, some of those backgrounds were hedge funds, and their hedge fund background I thought could be interesting to really look at how to develop that into the program we were developing on building out an indirect investment approach. So from a hedge fund fund-of-fund background to an impact investing fund-of-fund background, they went from being kind of that hard-charging, very much a hedge fund culture, to being completely hard-charging and belief in the impact investing story. I like that because it's a very different career track that they did, from transforming what was one of, you could argue, more of a short-term time frame to becoming fantastic evangelists about this impact investing viewpoint, that they're still doing their careers that way. And I just give that as a different career track that happened, that I happen to be able to see and watch over time, that I view as, again, my personal journey and what was satisfying. That would be another one. I will share one last one briefly. It would be that I've been involved in doing career guidance to business school graduates for many, many years. And that was always, maybe on one hand, you could see these that were interested in going in this direction. And just watching that go from the sort of minority viewpoint of those who wanted to dedicate, and it was a high risk move at that time, to now that you have the flood that say they don't want to go to strategy consulting, they don't want to go to startups in California, they want to go in not just investing, but impact investing. That's really something that is quite satisfying to see, that these graduates, the next generations, want this to be their career path. So I'd say all three of those are interesting from different perspectives.
Oh, fantastic. Thank you so much for sharing. Those are great examples. And the impact, the tangibility and making impact real that you shared in the first really resonates with me, as does the notion of being part of a community and seeing that groundswell of support and growth and take up is really exciting. So thanks for that, Matt. Let's shift gears and talk about the market. So in your vantage point, obviously you're looking across asset classes, across geographies, you've got the whole breadth here. And our field has grown quickly and it's still growing at a very rapid pace. But just in terms of the breadth and depth of opportunities, how do you think about it, Matt, from a strategy point of view, sitting atop the Allianz group and coming out of AXA? I'm trying to tease out a little bit across the asset classes, geographies, and themes which we can dig into. But how do you articulate, think about the opportunity set for impact investing?
I think that we're still at a phase where we have to help define impact investing and what it means compared to other areas within sustainable investing. And I think that it's worth doing here only because there's no one perfect answer in the market about definitions yet. So when you ask me the question, I'd say that I try to create in my own firm the trajectory from, let's say, more the ESG risk-oriented approach, which I really consider to be the flood of mainstream capital happening now, certainly starting from a European perspective, because we now have a mandatory regime around it. But I view that call that an asset management wave that's hitting us. And that is around how do you integrate ESG across all asset classes. We're still in that world, that's still happening, but it's going very quickly now. And then if you start moving towards more of what we would call the impact investing, I say that is a subset and still a different area. Even the development of the market was different, the ESG integration world. It's amazing. If you think about that, Lori, they were very much two different constituencies for years. They're now starting to touch a bit more. And the reason they're starting to touch is because the ESG integration world is being asked to show something about impact. And that's what's changing, I think, now that the entire market, and why I say that if you take that 10-year version from, let's say, 2020, 2030, we're still in it now, it will be a risk return impact world. And ESG is sort of the big wave that's going in that direction that will have light touches of impact as part of it. And so you can imagine if you have a future scenario, an investor looking to put money into a product or a strategy, whether it be retail or institutional, I think in 2030 that they will have a risk return and something about impact as part of that discussion, even if it's as light touch as a carbon footprint. Call that the most mainstreamed area of impact I see happening in the ESG world. And then in terms of really looking at impact investing, I think first about the private market area that I think has the most ability to show the tangible impact. And from a firm-wide view, that's certainly an area that I'm deeply involved in, whether it be blended finance, private equity, venture capital, but then rolling that into other areas of private investing like infrastructure, for example, but then rolling that also into the green bond world of measuring impact, and then thinking of public equity and how do we find the furthest area of what impact investing could be in an SDG aligned setting with demonstrable evidence when we go in that direction. I'm giving a long answer because that's my entire world today. That's what I have to do.
Matt, it's so thoughtful as always. I build that you would be thoughtful and really helpful. And what I'm hearing you say is that it's no longer kind of an either or and this sharp separation. It's and. So we're doing both. We need both. I love your notion that they're touching. There's delineation, to your point. Yes. There's delineation and important points of delineation. But there's touching, and I'm almost taking from your comments, these are my words, not yours, that the impact investing drive, efforts, demonstration have actually influenced the way the expectations on ESG are now expressed. Because as you say, it's no longer singularly through a risk assessment. So what are the elements of impact, even if it's a lowercase I, in some of the ESG inquiries? So that relationship between ESG and impact, I think, is really interesting as you've expressed that. And Matt, so think about that framing in the context of emerging markets. And how are you looking at emerging markets? I mean, we've just lived through this and still living through the global pandemic. Emerging markets, we've seen just a lot of money leaving emerging markets, actually, out of a risk and a defensive posture. How are you looking at emerging markets and emerging market opportunities at the moment?
It's definitely an area of commitment as a firm, and there's different ways that I'll explain that. There's at the level of initiatives, so initiatives that we're part of. If we just take the parent company and the Climate Finance Leadership Initiative, that's with Bloomberg and others, and Allianz was a charter member of that. That is really about how to mobilize capital into emerging markets. So that would be at that asset owner level of Allianz. And then where I sit on the Allianz Global Investor side, there's initiatives that we are doing. So the Emerging Market Private Equity Association, that's a group that we belong to. And that is also about how to mobilize capital into emerging markets. And the specific area of interest that we have is around impact investing. We've also dedicated teams around how to think about impact investing on the private market side of our book. So if we think about the private equity side, the venture capital side, I'll give you an example. We have a dedicated fund on looking at African venture capital. And we have been doing investments in venture capital in Africa. That's about 120 million euros of capital that we have put to work, that we're doing investments as we speak. I sit on the investment committee of that kind of work. We have done climate investing, also pushing that into emerging markets. So we have emerging market focus on climate investments. And on the blended finance side, we have done quite a bit of work on blended finance investing, really, again, focus on emerging markets in partnership with development finance institutions. We have a current strategy focused on a Paris-aligned program that we hope to have $1 billion that will be of capital that we're looking to put into that fund over time, which again is focused on emerging markets and measuring the impact of what we do over time. So I'd say that there's an initiative level where we're working with the market, so other industry groups, asset managers and the like. And then there's the actual evidence of the capital going into those markets that we are really focused on, whatever the seasonality is, whether we're in a COVID world or in a so-called normal world. That is a long-term commitment that we're doing.
That's fantastic. I really appreciate that. And I love your separation. There's a relationship, obviously, but the initiative level, because we need to also galvanize multiple actors, but then holding yourselves accountable to where your capital is going. And if you're sitting around a table where you're a member of an initiative, well, then let's also look at what we're doing in our own portfolio. And I really appreciate that combination and recognition. I think what we'll do at the moment, Matt, we want to dig into the actual movement inside institutional investment institutions. We're going to come back to that and dig into that. I'm just going to pause here for a minute because we've been talking about the opportunity set and invite David to join us and showcase the case studies that were just released by the Institute for a few minutes for the audience. And then you and I will come back in conversation.
Brilliant. Thank you very much, Laurie. So yes, as Laurie has just mentioned, what I'll do now is that I will give you a very brief overview of the case studies that we're launching today, but really they illustrate and they reinforce many of the key points that Matt and Laurie have been talking about just now. Just before we dive in, I did want to acknowledge the support of the FCDO, which is the Foreign, Commonwealth and Development Office, which has supported the creation of the case studies through its impact program, as well as the support of Dalberg Advisors, who have been our partners in this project. And I also wanted to say thank you to the fund managers and institutional investors who have very generously shared their insights as we're developing the case studies. So as Laurie mentioned, the aim of the case studies is really to dispel this notion that there are no suitable opportunities that are available on the market for institutional investors to do impact investing in emerging markets. And what the case studies show is really that there is this very broad and highly diversified set of opportunities that Laurie was talking about, and they are available today in emerging markets, and they are suitable for institutional investors because they enable them to achieve a suitable risk-adjusted financial return, and also the high level of impact that, for example, may match the preferences of some of the pension scheme members. So the case studies are based on evidence of 16 real-world actual investments that have been made by institutional investors. We are focused primarily on pension funds, but they also cover insurance companies and other type of institutionals. And so to be more precise and unpack this headline insight a little bit, there are basically three key takeaways from the case studies that I would like to focus on. So the first takeaway is this common idea that pension funds cannot make impact investments in emerging markets. Well, this idea is really not accurate. And frankly, at this stage, it's a bit of a myth that needs to be busted. The case studies that we have show that, in fact, more and more pension funds around the world, they are integrating emerging market impact investments into their portfolio. And this includes pension funds based in Europe, for example, in the Nordics, and pension funds that are based in countries such as the US, Canada, or Japan. So really, emerging market investments are becoming not the norm, but increasingly familiar for pension fund investors. And if you're one of them, then the intention behind the case studies is very much to encourage you to emulate your peers in this regard. And so the question on how to practically do that brings us to the second takeaway from the case studies, which is the really high degree of diversity of the set of impact investment opportunities that are available today for pension fund investors in emerging and frontier markets. And I will share my screen now, but I believe my colleague has also shared the link to the case studies in the chat. So please do follow that on your screen as well. And as you will see here, hopefully the screen has come through. And as you'll see on the screen, then the case studies include, again, all based on real life, actual examples of pension funds that have invested across very different asset classes. So you see there are examples across public and private markets, covering public bonds, covering private equity, covering private debt funds, even some very innovative instruments such as social impact bonds, as well as more familiar ones such as infrastructure and real asset funds. And for each of the asset classes, what we have done is that we have produced a very brief asset class summary, which provides a practical overview of the key trends and opportunities for that asset class in emerging markets that might be useful for institutional investors. And I should also mention that although we're categorizing the case studies based on asset classes, the high degree of diversity that we were referring to earlier goes beyond that. And the case studies include investments across very diverse thematic areas. So you have climate change mitigation, energy, infrastructure, agriculture, financial inclusion, housing, healthcare, really, you name it, as well as a very high diversity in terms of the geographies and the expectations in terms of social and environmental impact, and also in terms of the financial returns. And so to illustrate all this, we can zoom in on one of the case studies specifically. For example, the Emerging Markets Loan Fund, which is managed by FMO and investment partners. And as you'll see, the case studies provide you with very clear, very practical information, starting with some of the key details on the fund, including which institutional investors have invested in them, as well as the profile and the track record of the fund manager. And then you have some key data on the financial performance, the risk profile, and information where relevant on the portfolio composition in the case of funds, for example, in terms of team, in terms of geography, etc. The case studies also provide details on the investment selection and due diligence process, of course, very important, both of them, the key impact metrics, and also some investee spotlights that illustrate the real world impact that some of these funds have achieved through their investments. And the case studies also spotlight testimonies from the institutional investors that have been behind the investments, and we highlight some of the similar opportunities that are available currently on the market. And finally, we present some key observations from the instruments for an audience of institutional investors. And this last point brings me to really the third key takeaway, which is that the emerging markets impact investing space is really becoming much more sophisticated, very innovative, as it is seeking, as it recognizes the opportunity and the need to be attractive for institutional investors in order to mobilize private capital at scale. And you'll see in the case studies that really the asset managers and the intermediaries and others have really stepped up their game in terms of developing solutions that address some of the most common concerns of institutional investors, for example, around currency, around liquidity risks, or concerned about some of the ticket sizes. And these innovative mechanisms are all documented in the case studies, alongside of compilation of some of these best practices. And one last point, if I may, Laurie, what also struck me as we were developing these case studies really through the process is the impressive track record that many of the fund managers that we have profiled here have built, and how credible the opportunities that they're offering really are as investments for pension funds. And you have several of the products profiled here that are second, third, or even fourth generation funds. And some of the institutional investors that have invested in them have been very, very vocal and very public, very happy to go on the record about the readiness to keep investing into these type of products, including with the same managers, which obviously is a very great sign of fulfilled expectations on the one hand and of building trust on the other. So I think I'll stop here and I'll finish by inviting all those of you who have joined us today to have a look at the case studies and to reach out if you have any comments or questions. And in the coming weeks and months, we will continue to engage with pension fund stakeholders, including trustees, in-house investment teams, investment consultants, etc., around these emerging market investment opportunities. So if this is you, please do get in touch. And also we're hoping to expand the collection of case studies over time. So if you're a fund manager with proven experience in working with institutional investors, we'd also love to hear from you. So on that note, I'll hand it back to you, Laurie.
Thanks, David. That was terrific. Thanks so much. And as you said, there's nothing more convincing than a specific example, which I think we've all learned in our work. So thank you for that. And as you invited, people should share with us if they have other case studies to be featured and their reaction. And I think, Matt, you'll recognize many of those deals because when AXA's portfolio participated in a number of those across asset classes, similar to your opening remarks, I think it is very important, even though the depth of the impact may be different, there is quite a large and growing opportunity set. And with that, Matt, I kind of wanted to shift gears a little bit to how, if we assume, and we're all convinced by this growing opportunity set, how do we actually get the decisions going inside the big institutional players? Because, and you'll notice the case studies did feature pension funds, because our feedback as the Institute, and you and I both know this from our work, that they have been more challenging institutions to really galvanize for some understandable reasons, by the way, the complexity inside their organizations. Insurance companies, and you know this very well, have really been quite dynamic. A few of them, two that you've led, have been dynamic. And so I'm interested, openly, maybe starting with your AXA experience, if we might. You really emerged in that 10-year trajectory as a leading player. But when you arrived at AXA, AXA was not known as an impact investor, and you built that. I mean, I know it takes a team. I know you were part of a team, but you at least had your hands on the steering wheel. So if you can help us just understand what the actionable pathway was at AXA to go from impact awareness to impact deployment, that would be a great starting point for this section of our conversation.
So I will definitely do that. Let me just make one response to David's interesting case studies. That I think getting these kinds of case studies out to the market is really helpful. So I just want to applaud the work. I will bring that internally and advertise them. So I think they're really helpful to have those. And just to not forget that the challenge in what was just presented is that it's both impact investing and emerging markets. And whether it be emerging markets, which is already not easy, and impact investing, which is not easy, you're trying to do both. So let's just always be aware of the challenge of combining those two areas, which are definitely more niche in terms of allocations of large institutional investors, that we're not making our life easy, Laurie.
But you and I never do. We go for the deep end of the pool. That's where we like to spend.
Then in answer to your question on the AXA experience, so I think part of the way I thought about pushing this forward, because you're absolutely right, they didn't know what impact investing was, and by the way, very few people did at that time, because that's what I arrived there in 2011, and I brought this to the table pretty quickly afterwards, so 2011, 2012. So one area that helped me, I'm not sure that it's needed now, but it was needed then, is I did hire a third-party investment consultant, so that wouldn't just be my view, but that there be a view by, let's call it, you never get killed by hiring a consultant, a little bit of that sort of thinking of, let's have this be a third party, a bit more of an independent viewpoint that could come in as part of providing this consultation, which was really couched as a consultation about where should AXA go in its entire responsible investment plan. And that was, so I said, well, why don't we bring in a third party that will help with that? because I wanted to get away from either buying my vision, which I had a stake in it, a clear vested interest, to a bit more of let's have my thoughts be in a way supported by a third party view. So that I would just highlight as one technique that I found helpful, because it made impact investing part of a larger picture of what to do to shift the trajectory of a vision from what it was, which was a bit of a reactive vision, to a proactive vision that would encompass everything from, will there be areas of business that no longer are part of the investment set? The ideas around coal, for example, which came to be. Will there be an ESG integration plan across all asset classes? And then finally, what will be the tip of the spear, which was the impact investing? And that is how we got it into the area of what would be possible, as opposed to, hi, let's just go do impact investing, which I think would have been a much harder sell. So I think it's worth just highlighting that for everybody listening, that thinking through, if you're looking to put this on the table, that sometimes putting it as part of a bigger picture can be helpful. From there, it was then about how do we move it forward? And it was looked at first as a nice to have, because it was built as part of a program and not as this is a new asset class, you must put money to it, which I think, again, would have been too fresh. And even today is still a question of, is this an asset class? But it was more about, let's do something that is not just about risk oriented, but more about positive story building and shaping the market as an institutional investor. And so I'd say that was the piece of that was important to buy in, was moving from this idea of defensive to really being a shaper. And that as an institutional investor, AXA had an opportunity to get in there and be part of the debate, which was generally dominated by development finance institutions. And so we often found that we were the first institutional investor at the table of both deals, of looking at impact investment funds, and then starting to shape that with some new thinking about how do you make this institutional ready for others to come in afterwards. Mm-hmm. And then the last thing I'll say on your question was, it was by showing through doing investment committee meetings of putting money to work, that this could actually be a whole other area that was different from the traditional investment set that had been looked at previously, and that it could be something that also made money while starting to building new storytelling around how can investment be done with this impact touch that to that point in time had not been looked at.
That's so helpful, fantastic. I love your notion about embedding this across the business, and sometimes having a third party both validator, but helping to really understand those implications, if you will, as well as your notion of pivoting from defensive to offensive. So important. We hear that from several other institutional investors who have made that the defensive is the kind of the on-ramp, the access point, but then the opportunity set is going to offensive. My question, Matt, is AXA pretty quickly put out a wallet marker. You did allocate, you made a wallet, and you were one of the first to say, we now have an impact wallet. It's not because it's the be all end all, but it's going to allow us to focus, to have a dedicated team, to learn and build those muscles as you're describing internally. And at what point in the journey did you come up with that modality? I know then you moved beyond the wallet. You had one wallet, then another wallet, and now third-party money you're taking. But it was, I mean, my observation as someone in the industry working with you at that time, it was so helpful, even for us outside of AXA, to see that you had made an allocation. So at what point did you put that on the table?
So the first part was to get the funding. And so that funding was essentially, and I'll share another funny story about that. It was at first, I wanted to actually raise 500 million euro, which would have been huge. And AXA at the time said, well, let's go do your third party idea again, Matt, and see if there's enough supply for that kind of capital. And we brought in a third party group who then kind of put a little bit of it slowed me down slightly. Let's just put it that way, because they said, well, that's a pretty big number. So it went from 500 to 200. That was still the largest impact investment allocation at that point in time from an institutional investor into this field, but it wasn't quite as big a splash as I had been hoping, which was a $500 million splash I wanted to make. But those are just the funny stories we learn. So that was let's put that money to work and just see what happens with a 2-year, 3-year maximum window not to see results, but just to see deal flow and what kind of deals are we looking at, and that none of them blow up. The first question was, will any of these blow up? Back to more of a reputation risk management culture. And then it was, as we started to look through this and get closer to exits, it was much more of, oh, wow, how do we actually see the impact story and the investment story coming together? And lots of interest in being part of that over time. And so the wallet approach really happened in more about year 4. There was then this idea of, why don't we then think about this as more of a programmatic approach? And then the questions became, what other areas of impact investing could be tackled? And we started really with more of a social impact approach. The next area became more of the climate, and that's why you see climate just started to take off across the globe. And so then it became, how do we do climate investing and what types of areas to start focusing on? And then there was lots of different areas that we started to tackle and narrow our scope of discussion around where we want to really position ourselves. And then somewhere around year 5, 6, 7 became a bit more about, is this an asset class? And if so, present a business case for what we should do differently going forward.
Fantastic, fantastic. I've got a couple of other questions, but I want to pause here and see in the Q&A window, David, what questions are coming in for Matt? Let's just see questions that we're getting, and then I'll continue. I've got a couple of more. David, are you there?
Yes. There is a really good question from Isona, which I think is getting at what institutional investors can use using their position, using the sizable allocations of capital, of course, to perhaps mobilize a bit more of the market and to really keep it moving beyond single investment. So, for example, supporting some platforms that might enable deals or things like that. Is there anything that is relevant there?
So in terms of, let me make sure I understand the question, platforms still about where to invest, or is this about what to support that builds the system, or is it both?
I think it's a bit of both, but the market building sounds very interesting.
And I'm reading a little bit, Matt, into mobilizing others, because to really have the change we're trying to have in the markets with the aspirational goals that people like yourself express, it's not only Allianz we need, or only AXA. We need to, and that's why you're part of these initiatives. But maybe you could speak to that, what you've seen as kind of pathways to really get some others joining alongside.
So I'd say the important first step in showing others, or that pathway, will be about, do you have examples? And you just presented us some great case studies, David. But from an investor view, we spent a lot of time thinking about how do we start to template an easy to understand debrief about what worked in this investment in terms of the way we looked at it, in terms of what the outputs are from an impact view, and in terms of the return profile. And that you can start to show a body of work that is not just the one successful example. You need more than the one, otherwise it's not credible. So you need to show a stream of different examples that really cover different themes, different types of asset allocation perspectives, whether it be geographic or whether it be debt versus equity. And from showing this as a trend, all of a sudden it starts to make it very much possible for other investors to say, oh, it's not just that one specific little niche that worked, but more about a body of work that you can start to think about as an area of just new styles of investing. You know, I'll give you the example we often hear about right now is if you think about hedge funds. When hedge funds first started, there was a lot of questions of what is a hedge fund? And then over time it became there's hedge funds that's more merge arb, or it's about thinking of hedge funds long short. And all these sort of monikers came to be that people now tend to understand. We're still in that naming and forming phase of impact investing to get other investors to understand what is this field. And that's why we need examples of what has worked and then start to shape them into, is that an SDG aligned investment? Is that a hardcore impact first investment? Is that a thematic investment? Because we need nomenclature to be better understood by the investment institutions around the globe to get off the sidelines. It's still hard for them to understand what is this area because we're still shaping it.
I think that's fantastic. And I'm going to invite you, David, to say another one, but just one double click on that, Matt. If we're arguing in a way that there's a density of opportunity, we've got to show that, not just for pipeline, but what's been done. is what you're saying. Show that body of work, which I think really aligns with the opportunity set we're trying to showcase. And I also really like your notion about how you kind of build the momentum. My question to you is it now the case that the competitive factor is playing out? So when you started at AXA, you didn't really have peer competitors doing this ahead of you. You didn't. Now, if you're sitting inside an insurance company or a pension fund, you can point to some of your competitors in quotations, or at least your peers who may be ahead of you on this journey. Does that help to kind of stimulate and create momentum inside institutions? How's that playing out in your view?
So just to make sure it's clear to the audience, I sit inside the asset management company, which is owned by an insurance company in terms of Allianz GI. So within Allianz GI, there is no doubt that seeing the stories of different types of strategies being launched, exits being done, that spurs discussions at the insurance company level and within the asset management arm. So I view that is actually a good thing now in terms of where we're at, which is call it chapter 2 of the competitive forces now showing product innovation, showing successful stories, and spurring others to think that they should do this as well.
That's helpful. Thank you. David, another question from our audience.
Yes, there was a question on the role of policy and regulation in all of this. So what are the, I suppose that's one for Matt, what support/incentives do institutional investors such as yourself need from policymakers and regulators? What changes would you like to see to enable more impact investing in emerging markets?
I think that one of the areas that will be helpful, if we start, let's focus on Europe for a moment because it's probably the most activist in this area. I think what is for the greater good, even though we're still in the early parts of the challenges of adhering to this regulation, this SFDR regulation, is that it is leveling the playing field and saying that there's a certain zone that everyone must operate under when it comes to better demonstrating how ESG factors or even some aspects of impact investing are being put into product design. And so that is now, I think, a trend that is forcing all asset managers to up their game. So that would be one answer to regulation. What I think would be very helpful for impact investing specifically would be a bit more of some standard setting on key performance indicators. Everybody is looking for how do we show these outputs, and there's still a scramble because it's hard for how do we create the right zone of what is a measurement of carbon intensity or of the warming temperature of our portfolio or of social impact. And right now we're still in the experimentation innovation phase, but I think if we want to start getting other investors to put money to work, having some standards, even if they're not perfect, that we can start to point to as key performance indicators that you can use to measure your impact is just going to help others be more comfortable to move that money from the sidelines into deployment. So even if it's not perfect, I'd say let's get that a bit of a baseline so that we can keep moving.
That very much aligns with the Institute's focus as well, Matt. We actually fully concur with you that we have to be working hard to create some coherence, some consistency around that conversation. And you say, let's not let perfect be the enemy of the good. Let's get started. We can constantly improve in the field. We've demonstrated how we can be improving as we go. That's very helpful. David, is there another question?
Yes, perhaps a follow-up one on this. Matt, what are your thoughts on what the IFRS Foundation is doing on the Sustainability Standards Boards? And do you have any, are you looking forward to it, or do you have any concerns about it, as some people do?
Yeah, I'd say that, all these types of initiatives in general, when they're at the phases like I see this one at the moment, it's more about exploration phase, learning phase for us. So it's not, fear, David. It's more of a, well, let us think about what that would mean. And is that helping to create more clarity or adding more of a complexity? That's a bit of how we approach it, and we don't have a firm-wide view yet.
And Matt, if I could on that one, when you're going for clarity and trying to resist the default complexity, because all of what we're doing is difficult, the linkage between the enterprise level indicators and investor and portfolio indicators, What are your thoughts about that? Because some of these initiatives, as you know very well, are being led at the enterprise level. Investors want to see that, but investors have to look at their portfolios with certain indicators. What are your thoughts about the kind of bottom up, top down, and where these things come together approach?
I would expect on the bottom up, we have more indicators, more tailored approaches to investments and if we take private market at the deal level that we are putting, because that should be in a way some linkage that could be quite specific to the deal, the company, the industry, and the thematic on impact. At that more top level, what we're trying to do, and there's no perfect way to do it yet, by the way, is to say out of the different types of factors that we collect at an individual deal level, can we take some of those and aggregate up? And either it's a straight aggregation or we have to make some assumptions. But I think that at that sort of enterprise level, what we tend to think about is either a lives improved type of metric, because that one we can think about ways to do that. If it's more environmental, it's more about emissions that might have been saved or not deployed. We can look at land preserved. Those are classic levels at the highest aggregate perspective that we can do, but you do lose the richness at that deal level or at that more specific KPIs that are bespoke to a deal. And I think that there's still quite a bit of work that we need to do, both of how do we better connect them and how do we create another area that interests me is the visualization of them. So I think right now it's still too static in the way that we present this information, and I'm happy to start seeing innovation on visualization software out in the market, because that brings it to life in a way that is much more pertinent. And I think if I just go one last piece on this, on the retail investor level, it's very hard if I just see one of the challenges that we face when they say, oh, it's a carbon intensity of X that you will see in, let's say, public market investments. What they really want is, well, how much did that change, for example, that cars are now off the road? You know, this is a classic one that, while not perfect, retail investors can better relate to. And when I go back to that, what I said earlier, Lori, about this vision of 2030, where we are with impact, whether it be private market or public market investing, we need to get to an ability to make this much easier to understand. And we're pretty far from that at the moment.
I agree. And tangible, real, clear. I do appreciate your use of the term improve when we talk about lives. We need to move on from lives touched. You can touch all kinds of lives. How are we improving people's lives, and in what ways, and what does that look like? I just wanted to make sure that the audience heard that, because your word choice was important.
That nuance, you're right.
David, anything else from the Q&A? I've got one more, and then we're going to go wrap up. But anything else? We have time for one more.
Yeah, another question, which is about the capital that lies within the emerging markets themselves. How can this capital be mobilized to invest into these markets rather than mostly focusing on capital that is moving from the matured markets outside in, basically?
Well, I'd say that one of the areas that we are working with on emerging markets is that it's twofold. It is working with let's say the outside in perspective. That could be donor capital, it could be institutional capital, but we're also working in countries with the treasuries and the finance departments on thinking about how they can better use some of their capital that might work within the emerging market structure by having vehicles that give them some protection. And those vehicles of protection might be coming from some of the outside in donors that are bringing a bit of a first loss guarantee. And so it does start to help push the overall perspective of how do we mobilize capital so that it's coming from different types of investors, those that might be based in emerging markets, those that are in so-called developed markets, but by having a structuring element that made it easier for either one to think about this area as an investment opportunity. I'd say that's one area, David. The others are that we are starting to get funds. If we take now some private investment funds that are based in these emerging markets. And I mentioned earlier, we have an Africa Growth Fund that is all about putting money to work that is going from an outside in perspective to be, let's say, assets under management that are going into funds that are based in the region. So we have funds on East Africa, West Africa as an example, and they're then putting that money to work themselves. as based in the region local investment funds into different companies. And so it's really starting to create that entire cycle of startup capital that will be the boost into how do we create the same kind of threats to incumbents in those parts of the world that we try to create in other parts of the world. So I'd say these are two different angles that we're looking at as ways to do that mobilization.
That's fantastic. And as we were speaking, I was thinking about your reference earlier about ESG and impact no longer being two separate silos. In a way, hopefully, where capital is coming from also, we're pulling those together in a similar way to the progress we've made with ESG and impact. And Matt, I have two final questions, if I may. One is about the just going back to that decision making, the internal constituencies. So you mentioned, you highlighted and clarified for the audience, you're sitting inside the asset management arm of Allianz Insurance Company parent, but also at AXA similar. You have a real sense of what are those constituents I really need to be pulling in, addressing. It's multiple, we know that, but any insights you can share on how on successes and what you've learned on how to accelerate the buy-in that you need across the board. And then we'll go to the final wrap up, but maybe just a word on that.
I think that where you can find the stakeholders that would be interested in this initiative and have that be not too many where it gets unwieldy, but probably not just the investor, not just the CIO, but having some others involved, that's probably going to be helpful. But each institution has its own culture on these things. And so I'm very aware that in one market it might not be the same as others. Different ideas of fiduciary duty, Lori, right? Anglo fiduciary duty can be more stringent than a fiduciary duty concept in continental Europe. So these kind of things, we can't ignore them. But what I would say is on my own experience with it, the stakeholders I had involved in pushing this through were certainly the investment teams. You need them because that's where the decision-making final piece comes in. It was having the corporate sustainability teams that saw this as an angle to really bring a much more investment piece to their work and bringing in their policy understandings and trend analysis, and to have that voice in the room. That was a great tool for us. Communications and risk, having those two sides involved as well were important. And then finally, top level, C-suite, that had an interest in this from what I call the more Davos storytelling piece, right? So these are all ways to think about packaging it into then an ability to start working. And we then have created a committee that still exists today at AXA, which was this group of stakeholders that said, this is such an interesting area and it's great for impact investing. It's great for having discussions about what's the future of where the market's going. So that's a group that started to actually create language together. And one thing I'll just share, which was kind of one of those moments, it took probably 6-7 years, but there was a moment where the chief investment officer at the time at AXA called me up and he says, you know, I've been a bit of your skeptic to your belief system, and that's a bit of how we work together in our overlapping interests. And he said, but I did get an email recently from a part of the firm that was an employee that he didn't know who that person was in the insurance company, who just wrote an email saying, thank you for what you're doing in impact investing. It makes me more proud to be an employee in this company. And he said that was the first time he'd ever gotten that kind of feedback and realized that the investments he was doing had become not just about how to manage the risk capital of the insurance company, but how to make a difference with that capital. And it really shifted his own prism about his thinking about his own job.
That is fantastic. I mean, I'm really taking from this, be deliberate in setting the table, making sure you're actually pulling people into the table, all the chairs around it. But I love that recognition of where the influence can happen and the reinforcement of that to the individual you've mentioned. Matt, in our last couple of seconds here, this has been such a rich conversation, but any practical advice for the audience, any last parting word you'd like to share with us on the angle of institutional investors and emerging markets in particular?
Yes, I would say that the first is when you set up an impact investment program, be aware that those first investments be on the safer side than the highest risk or the highest impact seeking side. I would say that you can get to that over time because that's really important as part of the shaping and changing, but that those first investments, be satisfied that you're getting started and that you might make a bit of a trade-off on how perfectly impacted it is, and also on being aware that you need some investment return enough that you get the interest level while having a viable impact story. But just be realistic. That's the first part, what I would call profitable impact approach, and make sure the profitable is within that area. The other piece is that articulate where you're trying to go, make it clear the vision and where you're trying to go, and that it's not about perfection. It's about rolling up the sleeves, similar to how I am right now with my shirt, and saying, let's start working together, but that you are thinking this through by having a base level of risk management so that you're not taking too much unnecessary risk while working to start building what is the unique proposition you're bringing as you start going into this and developing success stories and learnings along the way. And then finally, think about which initiatives that you want to be involved in as a part of this. If it's going to be more of a thematic towards environmental, there might be some areas that you look at as the initiatives where you get involved and engage with other investors to be part of that, what I think of as the technical capacity building, because we need the institutional investors to be in those discussions, because that's how we start to actually shape the entire industry over time and have a benchmark that we can all push ourselves towards.
Matt, as billed at the beginning, open, engaged, clear, determined, ambitious, pragmatic, and results-oriented. And thank you so much for this incredible conversation. As I said, it has been recorded. We'll share it with a much wider universe through our website, and we look forward to being in dialogue through the Institute and within our community. And thank you again for all that you're doing and all that you've contributed to the field and for this conversation today.
Thank you for the great questions and the dialogue, Lori. Thank you for the case studies, David. Really great to see that.
Super. And thank you all for joining us today. Bye-bye.
Goodbye now.